Welcome to Apex Capital Hub, your go-to channel for smart US investing without the hype. Today we're breaking down best index funds explained, the exact strategy Warren Buffett recommends for most people, including beginners. If you're tired of picking individual stocks, losing to fees, or wondering how to build real wealth in 2026 and beyond, this deep dive is for you. By the end, you'll understand what index funds are, why they're beating most pros, the absolute best ones right now in 2026, and exactly what to consider before investing a single dollar. Let's dive in. No fluff, just facts. First things first, what is an index fund? It's a simple investment vehicle, either a mutual fund or an ETF, that automatically copies or tracks a specific market index. The most famous is the S&P 500, which includes the 500 largest US companies like Apple, Microsoft, Nvidia, and Amazon. Instead of a fund manager guessing which stocks will win, the index fund just buys every stock in the index in the right proportions. You get instant diversification across hundreds or thousands of companies. This passive approach was pioneered by John Bogle at Vanguard in the 1970s, and today trillions of dollars are invested this way because it works. Historically, the S&P 500 has delivered around 10% average annual returns over long periods, turning consistent investing into serious wealth. Let's get honest about the advantages and downsides. No investment is perfect. Pros first. Ultra-low costs. Many have expense ratios under 0.05%, meaning you keep almost all the returns. Massive diversification. One fund spreads your money across entire markets, reducing single-stock risk. Proven performance. Most active managers underperform indexes over 10+ years. Tax efficiency due to low turnover. And simplicity. Buy once, hold long-term, ignore daily noise. Cons. You won't beat the market, you match it. In big downturns like 2022, you feel the full drop. Heavy concentration in top stocks like the Magnificent Seven dominating the S&P 500. Limited customization, no easy way to exclude controversial companies unless it's a themed fund. For 90% of investors, especially beginners and busy professionals, the pros crush the cons. Now the exciting part. What are the actual best index funds in March 2026? We focus on low-cost, highly rated options from trusted providers like Fidelity, Vanguard, and Schwab. Data from Bankrate, Motley Fool, NerdWallet, and Morningstar shows these stand out for performance, fees, and accessibility. Start with S&P 500 trackers, the core for most portfolios. Fidelity 500 Index, FXAX. Expense ratio 0.015%, tracks S&P 500 perfectly, no minimum. Schwab S&P 500 Index, SWPPX, 0.02% expense, rock solid. Vanguard S&P 500 ETF, VOO, 0.03%, hugely popular and liquid. For broader US exposure, Fidelity Zero, Large Cap Index, FNILX, 0% expense, literally free. Vanguard Total Stock Market ETF, VTI, 0.03% covers 3,600+ US stocks, including small caps. International diversification, Vanguard Total International Stock, VXUS or similar Admiral, low fees for global reach. Bonds for balance, Vanguard Total Bond Market, BND, 0.03% adds stability. Top picks. Right now, many experts say start with VTI or VAO as core, add international and bonds if you're closer to retirement. In 2026's volatile environment with AI growth and rate shifts, broad low-cost indexes remain king. Here's your pro checklist. Don't just pick the hottest one, Expense ratio under 0.1% is ideal. Every basis point matters over decades. Tracking error, how closely it follows the index, should be tiny. Index type and diversification, S&P 500 for large caps. Total market for broader, add international to avoid home bias. Fund size and liquidity, bigger is better for stability, billions in AUM. Tax efficiency, ETFs often edge out mutual funds in taxable accounts. Your goals and risk. Young? Heavy stocks. Older? Add bonds. Platform and minimums. Fidelity, Schwab often no min. Vanguard sometimes 3K for Admiral shares. Long-term consistency over short hype. Use tools like Morningstar or broker sites to compare. Build a simple portfolio. 60–80% US stocks, 20% international bonds. Ready to invest? Open a brokerage account at Fidelity, Vanguard or Schwab. Free trades, easy apps. Use dollar cost averaging. Invest fixed amounts monthly. In a 401k or Roth IRA. Max employer match first. Avoid these mistakes. Timing the market, buy consistently. Chasing last year's winner. Ignoring fees, going all in on one fund without diversification, panic selling in dips. Remember, index investing wins with time in the market, not timing. That's best index funds explained for 2026. Low cost, diversified, passive, the smart way to invest long term. Start small, stay consistent, and let compounding do the work. If this helped, smash that like button, subscribe to Apex Capital Hub for more faceless finance breakdowns, and drop a comment. Which index fund are you eyeing first? Turn on notifications, we've got more coming. Thanks for watching. Build that future.